Hi, Chris Maloof with XCountry Financial here. Have you heard the term GBI, or goals-based investing? Curious as to what it is, the similarities and differences between traditional investing? Stick around, we're going to educate you. Goals-based investing is taking the strategy or the philosophy of tying your investment vehicles or your portfolio to achieving a lifetime goal, such as retirement planning, funding a child's education, purchasing a home, etc., and not necessarily trying to get the greatest return or trying to hit a benchmark. Goals-based investing has really caught a lot of steam and gained in popularity since the 2008-2009 Great Recession, when a lot of folks were trying to chase the highest rate of return they could get in their portfolio. From my travels as a financial and investment advisor, when I hear these stories and I meet with some folks that were maybe in their 50s, close to retirement or in retirement, the major indices lost over 50% of their value during that period. So put that in perspective. You know, if you're 3 years out from retirement and you just lost half your nest egg, or if you're in retirement and just lost half your nest egg, you know, what does that look like? That's bad news. So again, when I meet with folks like that, I ask the question, number one, what were they invested in? Well, a lot of times they were way too heavily weighted on the equity side and took a big hit when the major indices and when the stock market took a big dive. The second question I ask is, were they working with a professional, i.e. were they working with an investment advisor? And what do you think the answer to that question is? Since this is social media, that becomes a rhetorical question. No, they were not. You know, they were squirreling away on their 401k or their personal IRA that no one had really taken a look at in a number of years, and they were completely misallocated. So goals-based investing takes the philosophy and, again, the strategy of putting together a compilation of investment vehicles to help you achieve a lifetime goal, again, such as retirement, funding a child's education, down payment on a house, etc. And we're not necessarily looking to hit the highest benchmark or get the highest rate of return. So what are some of the differences between traditional investing and goals-based investing? Well, traditional investing historically has been geared more towards or centered towards institutions. So that is an investment company, an insurance company, an individual that has $50 million or more in investable assets. You know, an institution like that has a much longer time horizon than an individual does in terms of, you know, maybe saving for retirement or a child's education. You know, a corporation, they could be in existence into perpetuity. You know, some have been in existence for over 100 years. So that's a much longer time horizon than an individual's. Second, the products are selected by a risk profile. So when you meet with an advisor, you meet with an investment advisor, you go through some questions. You know, what's your risk tolerance? What's your experience in investing in the market? Have you been through some market downturns? You know, some ups and downs and some basic market dynamics and economic cycles. You know, what's your experience level there, and what's your risk tolerance? What are you comfortable? How much risk are you comfortable taking? And then you design a portfolio based on that. Well, that might not necessarily be the best philosophy, particularly if you're investing for multiple things. You know, the time horizon for retirement is significantly longer than maybe saving for a down payment on a house. You know, that could be the difference between 30 years and 5 years. Well, those portfolios or those goals would demand a different investment vehicle. The focus has been benchmark performance. You know, again, this is single risk awareness. You know, everyone trying to beat like the S&P 500. Well, again, what is your time horizon and what's the overall objective or goal of that particular investment or that combination of investment vehicles? You know, that might not be the best thing when you're chasing return or trying to beat a benchmark. That could put you in a precarious situation, again, which is what happened in 2008, 2009 during the Great Recession. So, a goals-based investing, you know, again, that is centered on an individual. You know, what is your time horizon? What is your risk level? What is our goal? What is our objective as an individual? What do you want your dollars doing? Are you interested in ESG investing? You know, is that something that, as an individual, you want your dollars working in that space or in that sector? Products, again, are selected by goals. You know, go back to my earlier example. The time horizon for retirement and the time horizon for saving for a down payment on a house could be dramatically different. You don't necessarily want to use the same investment vehicles or a combination of investment vehicles to achieve both of those goals. So you need to build a strategy and a, again, combination of investment vehicles to achieve those goals. What's the focus? Progress, again, towards reaching a goal. Not necessarily saying, hey, can we outbeat the S&P 500? Well, if you're in retirement and you're heavily weighted on the equity side and you have a low risk tolerance and we go into a dramatic market correction, that again could put you in a very precarious situation. I come from an athletic background, so it's use what you know. And when I'm onboarding a new client, I take an educational approach, try and meet my clients where they are. They simply do not teach a great deal of financial literacy in the school system, so I try and bridge that gap. And I try and take very highly technical information such as investments, economics, market dynamics, and try and put it into relatable terms. So with a goals-based philosophy, there are 3 distinct stages throughout that time horizon. You know, whether it's retirement funding, whether it's college education, whether it's saving for a down payment on a house, there are different stages throughout that time horizon, and each stage demands a different investment vehicle or combination of investment vehicles. At XCountry Financial, we break that time horizon into 3 very distinct stages. The first one being the gain stage, the guard stage, and the goal stage. And we're going to take a deeper dive into each one of those stages and what our goals, what our philosophy, and what our approach should be within each stage. The first stage in our goals-based investment strategy is the gain stage. The strategy in the gain stage is accumulation to grow wealth. 2 drivers for growing wealth are saving and investing. Financial planning in this stage concentrates on exchanging a current want or need for a future goal or desire. So the first question to ask is, what are you saving for? What is our goal? This stage we need to fight against inflation. An enormous challenge to growing your wealth is the rising cost of living or inflation. Ever more costly expenses eat away at the wealth you're building. For example, in the 1980s, the target for a comfortable retirement was $1 million. Factor in inflation, and that $1 million swells to $3.16 million in today's dollars. To make your nest egg grow faster than inflation, we believe your wealth needs a helping hand in the form of taking investment risk. What's the right risk for your journey? Risk goes hand in hand with the rewards of investing. When accumulating wealth, you have to decide what amount of risk is appropriate when choosing across a spectrum of portfolios that range from aggressive to conservative. But accumulating wealth is about more than taking risk. Consider 2 other key components. Very few of us start with a large sum of money to invest. Instead, we make regular contributions to our investment plan. It's like putting bricks in a wall. Progress seems slow at first, but over time, contributions can grow to become an impressive achievement. The second key component is compounding. Think of this as making your contributions work hard so you don't have to. Compounding occurs when the contributions to your investment plan generate a return, and that return is fed back into the portfolio. Those reinvested dollars then can generate their own return in addition to the initial contribution, having a cumulative effect over time. Compounding is an important aspect of any growth strategy, even if fixed income is a large part of the portfolio. Warren Buffett said it best, no one likes getting rich slowly. In the gain stage, accumulating wealth can be exciting, but also hard work. The satisfaction that comes from seeing wealth grow is well worth the work and discipline it takes. You're making, in essence, a promise to your future self, and you can be proud of as you make progress along the financial journey to your goal. The second stage in our financial game is what we call our guard stage. We spend a great deal of time and effort accumulating wealth. We want to try and mitigate any market downturn. Preservation, the definition, to keep from harm. After accumulating wealth or gaining wealth, there's a point where new questions start to take center stage. How do I protect the wealth to achieve my goals? Has my risk tolerance changed? How will I react, or what pieces do I have in place to ward off a big decline in my portfolio? In a goals-based guard plan, 2 things are paramount: avoiding investing behavior mistakes and addressing investment risks. Let's address the first one, investor behavior risk. Emotions such as fear or doubt can play a huge role when making investment decisions, especially during periods of intense market volatility. The sad reality is many investors tend to make the wrong decision at crucial moments, resulting in a behavior gap in returns. For example, about 30% of investors 65 to 69 years old sold all of their equity holdings between February and May of 2020 as stocks fell, potentially missing the equity market's recovery to all-time highs. The safeguarding of our wealth to reduce investment risk. Your assessment of how much investment risk that you are willing to assume is probably changing. During the gain or accumulation stage, investment risk amounted to your comfort with riding the market's volatility roller coaster. What that doesn't cover is the maximum amount of loss a portfolio could suffer, what's called drawdown risk. And that's just one obstacle investors face. While you can have limited control over which risk to take and which to avoid, investors can choose a risk mitigation strategy to help them reach their goals. This illustration demonstrates the importance of preservation because of how long it can take a portfolio to recover from a market event such as the 2002, 2008, or 2020. As you can see from the graph, if you take a 50% drawdown in your portfolio, you need a 100% return just to get you back to break even. Make the math simple. If the market average is 10%, how many years would it take you just to get back to break even? Rhetorical question, that would be 10 years. Again, a lot of folks that were in retirement or close to retirement in 2008, 2009, probably did not understand drawdown risk and took a big hit, and they no longer have time on their side to make up that big drawdown. Okay, so a quick recap for our guard stage. Number one, investment risk. Beware of these typical risks. Investor behavior, drawdown, interest rates, sequence of returns, and asset class exposure. How can we plan for these risks? Drawdown constraints, fixed income, options collar, a beta targeting to reduce market exposure, or factor investing. The third and final stage of our financial game plan time horizon, and the funnest one, is our goal stage. We've spent a lot of time accumulating wealth, guarding our wealth, and now it's time to enjoy the fruits of our labor. So this is Mai Tais and sandy beaches. Eventually, you want to make sure that the nest egg you have worked so hard to build is there for you to meet your needs and fund your dreams during what may be a lengthy and active retirement. Consider this: if you retire in your mid-60s and live to your mid-90s, you have to make that nest egg last for over 3 decades. XCountry Financial identifies this time in your investment journey or your financial game as the goal stage. When looking for a retirement income strategy, we believe it should be designed to meet these common retirement needs: current expenses, future spending, and nest egg preservation. That leads into estate planning. One risk we run into in retirement is simply longevity. Retirements could be stretching 10, 20, or 30 years or more. Advances in pharmaceuticals and medicine are giving individuals access to an active, healthy, enriching, and long retirement that previous generations couldn't imagine. Can you picture yourself at age 95? It's going to become more common according to the Society of Actuaries projections. Living longer simply means your nest egg needs to live longer as well. The new retirement possibilities raise new issues for financial planning. A main consideration is how to stretch your money across your entire retirement. Per the Society of Actuaries, the probability of reaching age 95 if you're 65 years old right now and in excellent health, if you're female, 30% chance, and if you're male, a 21% chance. That's pretty good odds. The other risk we need to plan for and monitor is inflation. Inflation is a critical problem in retirement, and as it can eat away the value of your nest egg. Healthcare costs pose 2 challenges in retirement. It takes up a larger part of the annual household budget, and prices are rising rapidly. As we look at this graph, in today's dollars in 2021, what would cost $5,700 by 2051 will cost over $18,000 in terms of annual healthcare costs due to inflation and rising costs. That's 12% of a 65-year-old's annual household budget spent on healthcare. Now, the traditional 60-40 income portfolio would have 40% of your investments in fixed income. But can you rely on bonds? To help make your money last, your retirement portfolio has to beat inflation. In this age of ultra-low interest rates, too much fixed income can be a problem, especially if bond yields are below the rate of inflation. We believe in investing in stocks can help. Even in bad times, stocks have historically produced 20-year rolling returns that exceed the best years for fixed income. During your financial game and throughout your time horizon, this is what I help my clients do. We monitor all those variables. We make sure we have the correct combination of investment vehicles in place. If you found this information beneficial, hit the subscribe button, hit the notification button, and feel free to reach out with any questions. We're happy to help. Have a great week.